Hi guys, it's Stock Curry, and I spent this past weekend doing a deep dive into the US economy to figure out how bad things might get. I found some good things and some bad things. If you're going to invest in the stock market, you need to hear what I'm about to say. So let's get into it! Alright, I'm just going to go ahead and give you the bad up front, get it out of the way, then we're going to talk about the good, and then I'm going to finish with what's happening this week that could set the entire course of the stock market for the next 3 weeks. So let's start with the bad. In short, the bad is the US economy is experiencing the worst economy that we have had since the 1970s. To make matters worse, what we did in the 1970s to fix high inflation in a period of stagflation will not work this time around, which means the Fed cannot go Paul Volcker. It won't work. Now, here's the problem with that, is because the Fed cannot fix things with monetary policy, it is now up to Congress, the Senate, and the President to fix things with fiscal policy. The only way out of stagflation this time around is through fiscal policy. Now, as of late, so far, the Congress, the Senate, the President has done absolutely nothing to do anything with fiscal policy to fix the stagflation that we're currently in. And if this continues, and the Congress and Senate and President continue to do nothing, then stagflation will continue to get worse and worse and worse. And the timing is really, really hard to predict, but somewhere in about 4 to 12 years, not earlier than 4 years, not longer than 12 years, but somewhere between 4 to 12 years, the entire US economy collapses. Now, that's ridiculous, right? I'm not even talking about a recession. I'm talking about the literal collapse of the US economy. And that just seems insane. I mean, we're talking, what, Peter Schiff type warning here, right? But this would be like the worst case scenario, absolute worst case scenario. Let's say that the economy continues to get worse, Congress continues to see it get worse, and they literally just don't care. Like, they just like, whatever, we don't care. We're literally not going to do anything, and they let the economy collapse. Now, the reality is that's not going to happen, right? The Congress, Senate, President, they're going to step in and they're going to do something to fix the economy. It's not going to get that bad. But like I said, I just wanted to lay out the worst for you up front before we get to the good. Now, I do want to be clear that the Fed is going to do everything they can with monetary policy, but the Fed literally cannot fix inflation. And the reason the Fed can't fix inflation is their monetary policy can only fix what's called core inflation. And core inflation is already going down. The Fed's monetary policy, raising interest rates, is working because we see core inflation go down. But the reason inflation remains high are the things that the Fed cannot control, specifically food and energy. And the only way to get food and energy costs down is through fiscal policy and also some world political policy. And unfortunately right now, the Congress isn't doing anything on that end, but they probably will soon. Once we get past all of that, the question then becomes, well, when do we turn around? Like, how bad could things really get? And in my analysis and research, again, worst case scenario here, before I get to the good news and why this isn't going to happen. Worst case scenario, the stock market falls 75% from highs, which we were already down 25%, so knock another 50% from there. The unemployment rate hits 11%. Foreclosures on houses, they hit 6%. And the auto loan market, we end up with about 12% repossessions in autos. It gets really, really, really bad, right? The worst in 50 years. But even in the worst case scenario, it's not as bad as the Great Depression. And that's worst case, okay? So that's the bad news, the worst of the worst. Worst case scenario, it's the worst in 50 years, but it's still not Great Depression worse. All right, let's get into the good news. Let's get to a little bit of reality here. Reality is, at some point, Congress is going to step in. They're going to enact fiscal policy. They're going to fix this. Now, the other good news is that if we look at the housing market, obviously in 2008, the housing market is what caused the major recession in 2008, the great financial crisis, where the banks were about to go collapse and it looked like everything was about to fall apart. And in 2008, when I look at all the details, The biggest, most telling thing in that was one simple thing, and it was the CDO market. CDOs are collateralized debt obligations. Essentially what that is, it's the worst of the worst when it comes to house mortgages. So if you look at your home mortgages, there's a few select home mortgages from borrowers with really bad credit or a history of delinquencies, or, they've got weird mortgages like ARMs and things like that. And those are the worst of the worst. And those mortgages are very, very difficult to sell. And if the mortgages don't sell, then they become CDOs. And these CDOs essentially represent the worst of the worst of the mortgages. Now, in 2008, there were twice as many CDOs as there are today. So even if we got a major financial collapse and the housing market collapsed, it would only be half as bad as it was in 2008. Now, the other thing I looked at were the bank stress tests. And these were obviously very, very encouraging because the Fed looked at a number of things in order to determine how well the banking system might handle a major recession. And the Fed looked at things like commercial mortgages dropping significantly, corporate bonds going default in a large amount. They looked at unemployment getting up to 10%, which unemployment right now is at 3%. So unemployment going to 10%. They looked at the stock market dropping by 55%. The Fed really looked at a really, really bad scenario. The bank stress test showed that in that really bad situation, the banks would only suffer about a 25% loss. And they would still have a 75% buffer before they really ran into trouble. And the worst case scenario is only 20% worse than the Fed stress tests. So if the Fed stress test showed a 25% loss with a 75% buffer, and it's only going to get 20% worse than 25% loss in a worst case scenario, the banks are going to be fine. So not only do we have the mortgage market that can only be half as bad as it was in 2008, not only do we have banks which are perfectly fine thanks to these stress tests and these much higher collateralization requirements, overall, the banking system, the mortgage system is in a much stronger place than it was in 2008, which is all very, very, very good news. The other really good news that I saw is that in the bank stress test, they did not look at consumer debt at all. They didn't look at residential mortgages dropping. They didn't look at consumer credit cards going default. They didn't look at auto loans going on default. They didn't look at any of this. And what I realized in doing more research is the Fed actually has a plan in place that if the consumer side of the economy starts to get too bad, the Fed is going to react with massive quantitative easing. And what we have shown is that when the Fed does quantitative easing, it has an immediate positive effect on consumers. So the Fed knows that if they're able to tighten up, if they're able to get interest rates high enough and do balance sheet runoff enough, that if things start to get bad on the consumer side of the house, they can just do quantitative easing again, and that's going to fix the consumer side of the house. So the Fed essentially is looking at the banks, doing these stress tests. They're saying, look, if things get too bad on the commercial side, you're on your own. You've got to be able to handle that. We can't help you. And all of the data and stress tests show the banks are going to be just fine being able to handle that. And the Fed is saying if things get too bad on the consumer side, the Fed is going to step in to fix the consumer side. And history has shown throughout 2009 through today that the Fed is very, very successful in getting consumers to spend money again and helping consumers out. All right, so that's all the good news. Even though it looks bad and it may be the worst recession for people and consumers since the 1950s, as far as our financial system in mortgages and with banks, it's actually nowhere near as bad as it was in 2008. It's significantly better. Okay, let's get into what's going to happen this week in the stock market, because we have some major news that's going to kickstart all of this, and it's really going to affect the stock market for the next 3 weeks. So let's talk about what's happening. So this week we have our June CPI data coming out, and then we have the start of earnings season. In May, CPI was 8.6%, which was a surprise to the upside. Again, this was headline CPI. Core CPI was lower. And in June, economists are expecting CPI to come in at 8.8%. Now, that would once again be the highest in over 40 years in this country, and it would be higher than May, and it would point to the fact that inflation is not going down. Now, if that happens, and we do get inflation at 8.8%, or heck, even if inflation is 8.6% or higher, that means the Fed is going to have to be very, very hawkish for their interest rate hike. And right now, the market is pricing in a 75 basis point rate hike. If the Fed comes out and they say, you know what, we're just going to do a 100 basis point rate hike, then you can expect the stock market to fall. In fact, I think any CPI number at 8.7% or higher is going to cause the stock market to fall on Wednesday. Keep in mind, this is Wednesday morning. And this could put downward pressure on the stock market for the next 3 weeks. So it's something to keep our eyes out on and just keep in mind that this is coming. Now, the thing that could offset this, and this is the big unknown, are the earnings. Earnings season starts this week, with major earnings starting Thursday morning. So let's talk about the earnings that are coming up and what we can kind of expect for this week. So we don't really have anything major on Monday. On Tuesday, we got PepsiCo, and on Wednesday, we got Delta. But both of those are going to be completely overshadowed by the CPI numbers that are coming out Wednesday morning. So the first real earnings that are really going to affect the market actually come out Thursday morning. And the three big ones are going to be JP Morgan, Morgan Stanley, and TSMC, which is the Taiwan semiconductor company. Now, of those, JP Morgan is the big one. And the reason is JP Morgan is the largest bank in the United States. And Jamie Dimon is the CEO of JP Morgan, has by far the best insight into the economy. Whatever he says, especially during his earnings report, is going to move the markets. So we're going to have to be very, very careful and listen to what Jamie Dimon says Thursday before the markets open in the earnings report, because whatever he says is going to move the markets probably for the next 3 weeks. And that's going to be a big one. Now, Friday before the open, we also have Wells Fargo and Citigroup and then United Health Group. And those are all going to be really big as well. We have a few other smaller banks as well, including BlackRock, PNC, Bancorp, BNY Mellon, and State Street. Now, this is a big week for earnings, and it really actually concerns me a lot. Let me explain why. While the expectations are for earnings to go down, we're expecting revenue to go down, we're expecting margins to get squeezed, we're expecting earnings to go down. What's ridiculous in all of this is the fact that analysts have not lowered their price targets. If I were to guess, it's just a guess, is we could see extreme volatility when the earnings actually come out. And then over the next day or two, after earnings are reported, analysts start lowering their guidance, and that causes the prices to go down. So it's possible we could have a delay in the price drops where the price does something insane, completely unexpected and unknown when earnings are actually released, but then the price drops over the next day or two. Long story short, I am not playing this earnings season. This has got to be the riskiest earnings season I have ever seen. I am not touching it. I'm not going anywhere near it. That said, I did buy put options on Friday. I bought put options on both SPY, which is the S&P 500, and QQQ, which is the NASDAQ. Now, those put options have expiration dates of August 19th. And essentially, I just plan on holding those through the end of July and selling them at the beginning of August. I think CPI is going to cause stock market to go down. I think earnings are going to cause stock market to go down. I think the Fed meeting at the end of July is going to cause stock market to go down. And I think Q2 GDP, which will officially put us into a recession, is going to cause the stock market to go down. I hope you enjoyed this video and got a lot out of it. If you haven't already, don't forget to hit the like button and subscribe. And if you're on YouTube, click the bell icon and click all so that you can get notified when I release my next video. I wanted to let you know that on Monday evening at 7 p.m. Eastern Time, I'm going to be live with Larry Jones and Stocks with Josh on Larry Jones' channel. If you want to come see, we're going to talk about the housing market, the economy, and the stock market. We're going to talk about our Moo Moo Millionaire Club investing challenge, and it is going to be a great time to learn a lot from all three of us. So come join us on Larry Jones' channel Monday at 7 p.m. I'd love to have you there. and I will see you tomorrow.